Okay, let's unpack this. Have you ever stared at your crypto wallet, seen some free tokens land from an airdrop, or earned a little yield in DeFi and just thought, sweet, free money?
Uh-huh. Happens all the time.
Well, here's where it gets really interesting. That free money, and even seemingly simple things like, moving tokens between wallets or paying a gas fee,
Yeah.
they can have significant tax implications. And the IRS, they're becoming very aware of this stuff. Are you absolutely sure you're reporting everything correctly?
That's the core challenge, isn't it? I mean, the world of digital assets moves incredibly fast, brings all these exciting new financial activities.
Right.
But these innovations often outpace clear regulatory guidance, particularly, when it comes to U.S. taxes.
For sure.
Beyond just buying and selling, activities like decentralized finance, staking, NFTs, even cross-chain interactions, they introduce layers of complexity most people just aren't prepared for.
Absolutely. And that's exactly what we're diving into today. We've gathered the latest IRS guidance, important revenue rulings, insights from tax pros who specialize in this.
An expert, yeah.
To help us navigate the maze. Our mission in this deep dive is to take the source material you've shared and really unpack the tax treatment of these trickier crypto activities. Staking rewards, airdrops, hard forks, lending, liquidity pools, yield farming, wrapping, bridging, even those pesky gas fees.
Don't forget gas fees.
We want to give you a clearer picture of your obligations.
And to understand any of this, really, we have to start with the fundamental principle the IRS established years ago and keeps reinforcing. Digital assets are treated as property.
Property, okay.
For U.S. federal income tax purposes, this isn't an option, not a suggestion. It's the bedrock.
Property, not currency, not some special investment vehicle with unique rules, but property.
Right.
Like owning stock or land.
Exactly. Or even a collectible, in some cases we'll get to. And this classification, it's key because it means the well-established general tax principles for property transactions, they apply to your crypto.
Okay.
This was first laid out way back in IRS. Notice 2014-21 reaffirmed, built upon in Reverend Rule 2019-24, and clarified more recently in things like Notice 2023-34. The message from the IRS has been pretty consistent. Treat your digital assets as property.
So if crypto is property, that means most things you do fall into one of two main tax buckets.
That's the basic framework. Ordinary income or capital gains and losses.
Income or gains losses.
Yeah. Pretty much every interaction you have with digital assets, receiving them, getting rid of them, it typically results in either recognizing ordinary income or realizing a capital gain or loss. Getting that distinction right is absolutely fundamental.
Okay, let's start with ordinary income then. What specifically counts as ordinary income in crypto, based on the sources?
Generally, ordinary income in the digital asset world comes from receiving new units of cryptocurrency or other digital assets, especially when you get them as like a reward or a payment or a distribution.
So it's like earning new value directly.
Exactly.
Yeah.
Rather than just selling something you already owned.
So receiving crypto as payment for goods or services, like if a freelancer gets paid in Bitcoin.
Precisely. If you receive digital assets as payment for property you sell or services you provide, whether that's wages from an employer or income as an independent contractor, that's ordinary income.
Okay.
It falls under the broad definition of gross income in Section 61A of the tax code.
Good.
And Section 1.61-1A clarifies income can be in any form, including property.
Right.
The fair market value, the FMV, of that crypto at the date and time you receive it, that's the amount you include in your gross income for that tax year.
And just to be super clear, that fair market value you report as income,
Yeah.
that becomes your cost basis for that specific bit of crypto later on, right?
Absolutely crucial point, yes. You've paid income tax on that value, so that reported FMV is your starting point for calculating any future gain or loss when you eventually dispose of that crypto.
Got it. So it prevents being taxed twice on the initial value.
Correct. It aligns with long-standing principles from cases like Glenshaw Glass, which defined gross income broadly as undeniable accessions to wealth, over which the taxpayers have complete dominion.
Dominion and control. That phrase again?
Yep. And cases like Coons and Rooney applied this to property received as compensation. Section 1.451-1A also says for cash method taxpayers, income is reportable when you get that dominion and control. So the principle is, if you gain control over new value, and it's not just getting capital back or a loan, it's probably income.
Okay. So beyond direct payment, what are the other common ways people get ordinary income in crypto that might be less obvious?
Based on recent guidance and analysis, this definitely includes activities that generate new tokens or rewards.
Like staking.
Staking rewards, yes. especially validation rewards and proof of stake. Those are considered ordinary income. Revenue rule 2023-14 confirmed that directly.
Oh, okay. What else?
Airdrops, those unsolicited token distributions, also taxed as ordinary income.
Even if you didn't ask for them?
Even then. Rewards earned from DeFi, like lending your crypto out or contributing to liquidity pools, yield farming, generally ordinary income too, and receiving new digital assets that are created from a hard fork. That can also be treated as receiving income.
So the pattern seems to be, if you didn't specifically trade for it or sell something for it or weren't just moving it between your own wallets and new crypto units showed up that you now control, you should probably think income.
For the most part, yeah. You're getting a new asset that wasn't yours before, adding to your wealth. The value you report as income is the fair market value, the FMV, of that crypto at the date and time you gain dominion and control over it.
That timing piece sounds critical.
It's absolutely essential, especially for things like staking, where there might be lockup periods we need to talk about.
Okay, that covers the income bucket pretty well. Now, the other big category, capital gains and losses. What triggers those?
Capital gains or losses result from the disposal of your digital asset property. Disposal is the key term the IRS uses.
And disposal is broader than just selling for cash.
Oh yeah, much broader.
Okay, let's break down what the sources say counts as a disposal.
Yeah.
Selling crypto for dollars is the obvious one, right?
That's the most common, yes. Selling digital assets for USD or any other traditional currency triggers a capital gain or loss. But critically, exchanging or trading one digital asset for another, those crypto-to-crypto swaps, also treated as a disposal.
Wait, really? So if I swap some Ethereum for some USDC stablecoin, that's taxable?
Absolutely. From the IRS's perspective, you've essentially sold the Ethereum. The proceeds are the fair market value of the USDC you received. You realize a capital gain or loss on the Ethereum based on its original cost basis. And then you acquire the USDC with a new cost basis equal to its FMV at that moment.
Okay, that's huge for traders. What else?
Using digital assets to purchase goods or services, that's a disposal too.
Like buying an NFT with ETH.
Yep. You've disposed of the ETH, or, paying for a coffee with Bitcoin, if you could easily do that. You've disposed of the Bitcoin, the FMV of the goods or services you bought. That determines the proceeds from disposing of the crypto.
And this even includes paying network transaction fees, gas fees.
Yes, this is one of the trickiest but most pervasive examples. Spending crypto to pay for gas fees on a blockchain transaction, that's treated as a disposal of that small amount of crypto used for the fee.
So paying gas triggers its own capital gain or loss.
Correct. A separate gain or loss on that specific amount of crypto spent on gas based on its value at the time versus its cost basis. We'll definitely need to dive deeper into gas fees later.
Okay. What about activities within DeFi? You mentioned forced sales.
Right. In DeFi borrowing, if your collateral value drops too low, the protocol might automatically liquidate, sell off your collateral. Right. That forced sale. It's treated as a taxable disposal of your collateral.
Ouch.
Which triggers a capital gain or loss based on the collateral's value at liquidation compared to its original cost basis.
Okay. What else in DeFi?
Also, disposing of a liquidity pool token, LPT, that receipt token you sometimes get when you withdraw your assets from a pool, that can be treated as a taxable disposal of the LPT. And of course, if you received crypto as income, say from staking or an airdrop, and later you decide to sell that specific crypto, that sale is a separate capital gain or loss event.
Okay, so it's a two-step tax process for crypto you earn.
Exactly.
Income tax when you get it based on its value then.
Right.
And then capital gains tax if you sell it later, but only on the change in value after you received it.
Precisely. That's the not taxed twice idea for things like airdrops or staking rewards. You're not taxed on the initial value again, just on the subsequent gain or loss from the point it became yours and you reported it as income.
How exactly are these capital gains and losses calculated? The basic math.
The calculation is the difference between the fair market value of what you receive at the time of disposal, so the proceeds from the sale, swap, or use, and your cost basis in the specific digital asset you got rid of.
And the cost basis is usually what you paid for it?
Generally, yes.
Yeah.
What you paid, including any fees directly related to acquiring it, or if you received it as income or a gift, the basis is usually the FMV when you received it.
And the holding period is absolutely critical for the tax rate, right?
Yes. This is key if you want to legally minimize your tax burden.
Yeah.
If you held the asset for 1 year or less before disposal.
Short term.
Right. Short-term capital gain, taxed at your ordinary income tax rate, That can be pretty high, up to 37% depending on your bracket. But if you held the asset for more than 1 year, long-term capital gain, taxed at potentially much lower rates, 0%, 15%, or 20%, depending on your overall taxable income level. For higher earners, that's a huge potential difference, 37% versus 20%.
That makes tracking holding periods super important for planning.
Yeah.
And losses. Losses can actually help, right?
Capital losses are definitely beneficial tax-wise. They can offset any capital gains you have, potentially wiping out the tax liability on those gains.
Okay.
And if your capital losses are more than your capital gains, you can deduct up to $3,000 of those excess losses against your ordinary income each year.
$3,000 against regular income.
Yep. And any losses beyond that $3,000. You can carry those forward indefinitely to offset gains in income in future years. This is the whole basis of tax loss harvesting.
Okay, with that foundation, property, income, capital gains, holding periods, let's dig into the specifics, those tricky transactions. First up, staking rewards.
Right, staking. Central to proof-of-stake blockchains. You lock up your crypto, help the network validate transactions, and you get rewards, usually more of the same crypto.
And Reverend Roll. 2023-14 really settled the debate on whether these rewards are taxed when you get them or only when you sell them, didn't it?
It did. The ruling confirmed. For cash method taxpayers, which is most individual investors, staking rewards are included in gross income.
Okay, income, but when?
The key is the timing. It's taxable when you gain dominion and control over the rewards.
Dominion and control. What does that actually mean in practice? Like when it hits my wallet?
Not necessarily. The IRS example in that ruling is helpful. Taxpayer A stakes M crypto. On date 1, A gets 2 units of M as rewards, but they're locked up, restricted by the protocol. A can't sell them, can't move them.
Okay, so they're visible but unusable.
Right. The restriction ends on date 2. But it's not until date 3 that the protocol actually makes those 2 units available to A with no restrictions. Now, A can freely sell, exchange, whatever.
So date 1 is when they technically popped up. Date 2, the lock ended, but date 3 is when they could actually use them.
Correct. According to the ruling, the fair market value of those 2 units of M on date 3, the date A, gained that unfettered dominion and control that's the amount A includes in gross income.
Not date 1 or 2.
No. It's about when you have the actual ability to exercise control over the asset, not just when it technically appears under restriction.
And this applies even if I'm staking through a centralized exchange like Coinbase or Kraken?
Yes, the ruling explicitly states the same principle applies. The rewards are income when the exchange makes them available for you to access and control.
The background section of that ruling also mentions slashing, where stakers can lose assets.
It did. Slashing is like a penalty in some protocols if a validator misbehaves. While the ruling focused on income, mentioning slashing shows the IRS is aware of the operational details, the risks.
How is slashing taxed? As a loss?
The ruling didn't definitively cover the tax treatment of slashing itself, but yeah, it would likely be treated as a loss of property. Another complexity to track.
Okay, so staking rewards ordinary income when you can actually use them based on their value then. Selling those rewards later is a separate capital gains event, using that initial income value as the cost basis.
Exactly. The two-step process again.
Got it. Let's move to airdrops and hard forks. Airdrops got famous with things like Uniswap dropping 400 UNI tokens on tons of users. Often a marketing thing, right?
Right. An airdrop is a distribution of tokens, usually free, often based on past activity or holding another token. It's different from earning tokens for doing specific tasks like bounties. That would usually be income for services.
And the tax treatment for airdrops, also income.
Airdrops are taxed as ordinary income. Similar to staking rewards, the fair market value of the airdrop crypto when you receive it.
Or maybe when you have to claim it.
Right. Sometimes you have to perform an action like interact with a smart contract to claim it. So it's the FMV at the time you receive or claim it. That's the amount you include in gross income.
So even if it's unsolicited, totally unexpected, just shows up in your wallet, bam, income.
Yes. As one expert, Wesley Barton, put it, it's smart to always report airdrops on your taxes, even if you didn't request or use them. The IRS views it like finding cash, basically, an accession to wealth.
And the not taxed twice principle applies here too. Income now, capital gains later on the difference.
Correct. Ordinary income tax on the FMV when you receive claim. That FMV becomes your cost basis. If you later sell those tokens, you calculate capital gain or loss based on the sale price versus that basis. Only tax on the change in value after you got them.
Where do you report airdrop income on the tax form?
Usually on Form 1040, Schedule 1, Line 8Z, which is for other income. You'd list the FMV on the date you received or claimed them.
And selling them later goes where?
That goes on Form 8949 and Schedule D, just like selling any other capital asset. Holding period starts in the date you receive the airdrop.
What about hard forks? The IRS mentions receiving assets from a hard fork in their guidance about that yes-no question on the tax form.
Yes, they specifically list receiving digital assets from a hard fork as an activity requiring a yes answer.
Implying it's a taxable event.
That's the strong implication. While there isn't a dedicated ruling like for staking, the consensus among tax pros, based on general income principles and how the IRS frames it, is that the value of new assets from a hard fork would likely be treated as ordinary income when you gain dominion and control.
Like receiving new property generated by something you already owned.
Kind of, yeah. It's like getting a dividend, but in new crypto from the fork.
So whether it's staking rewards, airdrops, or new assets from a hard fork, the pattern for receiving new crypto units as a reward or distribution is generally ordinary income based on FMV when you get control, reported on Schedule 1.
That's the general framework, yes. But always keeping in mind that specific protocol mechanics or restrictions could affect the exact timing of that dominion and control.
Okay, let's wade deeper into the DeFi swamp. Lending and borrowing. Fundamental stuff there.
Absolutely. Decentralized lending protocols. Peer-to-peer, no banks needed, governed by smart contracts. You lend crypto to earn interest, or borrow crypto using other crypto as collateral.
When you borrow crypto in DeFi, say you take out a USDC loan using your ETH as collateral, is receiving that loan taxable income?
Generally, no. Receiving the loan is typically treated as receiving get, not income. You have an obligation to repay it.
So the act of borrowing itself, not taxable?
Usually not. However, some platforms incentivize borrowing by giving you extra tokens, right? Rewards for borrowing.
Yeah, I've seen that, like yield farming on your debt.
Exactly. Those specific rewards, the extra tokens or interest you get just for borrowing, are generally taxable as ordinary income when you receive them based on their FMV.
Okay, so the loan isn't income, but rewards for taking the loan are income. What about repaying the loan?
Repaying the principal itself is not a taxable event either.
Okay, but what if I borrow crypto, like ETH, and then immediately turn around and sell that borrowed ETH?
Ah, that is a taxable event. You've disposed of the borrowed asset.
Even though I have to buy ETH back later to repay?
Yes. The IRS sees it as you received proceeds from selling the ETH you borrowed. This is treated as a capital gain or loss event right then.
What's the cost basis for that borrowed ETH I sold? 0.
No, this is nuanced. The cost basis is generally considered its fair market value at the time you received control of it through borrowing. So you compare the sale proceeds to that FMV at borrowing basis. It's separate from the transaction later when you acquire ETH to repay the loan.
Wow, okay, that's complex. Let's talk about the collateral side. You mentioned forced liquidations.
Right, DeFi loans require over-collateralization. You put up more value than you borrow, measured by the loan-to-value or LTV ratio. If the market crashes and your collateral's value drops, pushing the LTV past a critical point, bang, the smart contract automatically sells your collateral on the market to pay back the loan. Forced liquidation.
And that forced sale is taxable?
Yes. The IRS treats it as a taxable disposal of your collateral.
So if my ETH collateral had a cost basis of $2,000, I used it to borrow, the market tanks, and it gets liquidated when it's worth $1,500, I have a $500 capital loss on that E.
Exactly. It's a capital gain or a loss based on the collateral's FMV at the moment of liquidation compared to its original cost basis.
That's brutal in a crash. You lose the asset, and you might even owe capital gains tax if it had appreciated a lot before the crash that triggered the liquidation.
Precisely. It could be a really painful double whammy.
Ouch. Okay, switching sides. What about being the lender? Depositing crypto to earn interest.
Earning interest payments from lending your crypto in DeFi. That's taxable as ordinary income when you receive those interest payments based on their FMV at that time. Pretty straightforward, like traditional interest, just paid in crypto.
Now, some protocols give you a special token back when you deposit, right? Like an LP token for a liquidity pool, or maybe a token representing your lend assets. Does getting that token trigger tax?
This is one of the really gray areas. Lack of specific IRS guidance here. It was highlighted as a maybe taxable event in some source tables. The big question is whether depositing your assets in exchange for, say, an LP token is considered a taxable event right then at deposit.
Why the debate? Isn't it just like putting money in a bank?
Well, the conservative view, which is probably safer given the IRS's stance on crypto-to-crypto trades, treats it as a taxable exchange.
In exchange.
Yeah, you're disposing of your original assets, like ETH and USDC going into a pool, in exchange for a new, different asset, the LP token. Under this view, you'd calculate capital gain or loss based on the difference between your cost basis in the ETHUSDC and the FMV of the LP token you received at deposit.
And then when you withdraw.
That would be another taxable event, disposing of the LP token in exchange for the underlying assets back. Gain or loss on the LP token itself.
So potentially 2 taxable events just for providing liquidity and then taking it back?
Potentially, yes, under that conservative interpretation.
What's the alternative view?
The alternative argues that depositing into a pool for an LPT isn't really a disposal. It's more like a non-taxable transfer, maybe like putting assets into a trust or partnership where you still retain proportional ownership. The LP token is just a receipt. Under this view, no tax on deposit or withdrawal, cost basis just carries over.
That's a huge difference in outcome. And it creates massive tracking problems, doesn't it? How do you even know the FMV of an LP token at the exact moment of deposit or withdrawal? They aren't always traded.
It's a nightmare. The lack of clear guidance creates huge uncertainty. Most tax software defaults to the conservative view taxable swap because it's safer. If you want to take the aggressive no tax position, you need a very strong reason, meticulous records, and you absolutely should talk to a tax professional who gets this specific debate and the risks involved if the IRS disagrees down the line. Valuing those LP tokens constantly for active yield farming, it's incredibly difficult.
And that complexity naturally extends to liquidity pools, LPs, and yield farming more broadly, because they all involve depositing assets into pools.
Yes, LPs are the core of decentralized exchanges. Yield farming is just the strategy of moving assets around between different protocols. LPs, staking pools, lending platforms to chase the best rewards, usually paid out in various tokens.
So yield farming just bundles up all the potential taxable events we've been talking about.
Pretty much. Contributing to an LP might trigger capital gains losses on deposit, the LP token swap issue. Withdrawing might trigger another gain loss. And absolutely, any extra tokens or interest earned from providing liquidity or yield farming. That's ordinary income when received, based on FMV.
Income tax on the rewards, plus potential capital gains on all the asset movements.
Exactly. It makes tracking for active yield farmers extremely complex.
Okay, let's shift to another type of asset movement, wrapping tokens, like turning ETH into WETH, wrapped ETH to use it in DeFi.
Right. Wrapping creates a token on the same blockchain that represents another token, usually for compatibility. ETH is native, WETH is an ERC20 token representing ETH, usable in contracts needing that standard. You lock ETH, get an equal amount of WETH.
Is that simple technical transformation taxable?
Again, gray area. Lack of specific IRS guidance leads to debate.
What's the conservative take?
Conservative approach says, it's a crypto-to-crypto exchange. You dispose of ETH, you acquired WETH. Technically different assets, even if the value is pegged. Under this view, capital gain or loss on the ETH at the moment of wrapping. Unwrapping is another taxable event.
And the other side. The aggressive view
argues it's not a true disposal. It's just a technical transformation, putting the asset in a different wrapper contract. No real change in ownership or underlying value. Under this view, no taxable event. Original cost basis carries over from ETH to WETH. Wesley Barton's quote mentioned this possibility.
So just like the LP token debate, conservative, tax, aggressive, maybe no tax, but riskier.
Exactly. And same advice applies. Taking the aggressive stance without explicit IRS blessing carries risk. Talk to a pro if you have significant wrapping activity.
Similar issues with bridging tokens, right? Moving assets between different blockchains, like BTC to WBTC on Ethereum or ETH to Polygon.
Yes. Bridging enables cross-chain movement. You lock an asset on chain A, get a representative token on chain B.
Taxable.
Conservative interpretation, again, leans towards yes. You're disposing of your asset on the source chain, like BTC, and acquiring a new, different asset, WBTC, on the destination chain. Triggers capital gain or loss on the original asset based on its FMV when bridged.
Even though you intend to bridge back later, maybe.
Even then. The argument against tax is that you haven't really disposed of the underlying asset, just changed its location or form, like moving money between banks. But
the IRS defaults to crypto trades being taxable disposals.
Exactly. So the conservative taxable trade view for bridging is generally considered safer until specific guidance says otherwise. Different bridges work differently, adding more complexity, but the core uncertainty is the same as wrapping. Get advice if you do a lot of bridging.
Okay. Now, for the one that hits almost everyone actively using crypto.gas fees, those network transaction fees like paying ETH on Ethereum.
Gas fees. Payment for the computation needed to process your transaction on the blockchain, paid in the chain's native crypto.
And this is where things get surprisingly complicated, tax-wise.
It absolutely is. The IRS treats spending crypto on gas fees as a disposal of that crypto.
A disposal of the tiny bit of ETH used for gas.
Yep, which triggers a capital gain or loss on that specific amount of crypto used for the fee, based on its fair market value at the exact time of the transaction versus its original cost basis.
Seriously, so if I bought ETH way back at $100 and today I spend $10 worth of ETH on gas when ETH is at $2,000, I have a capital gain on that $10 worth of ETH.
Exactly. You dispose of $10 worth of ETH that had a very low cost basis if using FIFO, maybe 11 to 50 cents like in the earlier example. So your gain on just pinching the gas would be $9.50 in that case.
And this applies to every transaction that uses gas. Sending to my own wallet, interacting with DeFi, minting an NFT.
Any gas paid is a disposal of that crypto, triggering a potential capital gain or loss every single time.
That is an incredible tracking burden. Every click on the blockchain potentially has 2 tax implications.
It often does, because it gets even more complicated. Those gas fees also affect the tax math for the main transaction you were doing.
How so?
If you are purchasing an asset, say buying $1,000 of USDC with ETH, and you pay $6 in ETH gas, that $6 gas fee is generally added to the cost basis of the USDC you acquired. So your basis in the USDC is $1,000 plus $6 equals $1,006.
Okay, basis goes up.
But separately, you also have to calculate the capital gain or loss on the $6 worth of ETH you spent on gas, comparing its $6 FMV to its original cost basis.
Wow. So buying involves 1, calculate gain loss on gas spent, 2, add gas cost to the basis of the new asset.
Correct. Now, flip side, if you are selling an asset, say you sell USDC for $1,050 and pay $11 in ETH gas.
Okay.
That $11 gas fee is generally subtracted from the proceeds of the sale when calculating your gain or loss on the USDC. So your net proceeds are $1,150 to $1,039. You compare that $1,039 to your USDC cost basis.
Proceeds go down.
But separately, you also have to calculate the capital gain or loss on the $11 worth of ETH spent on gas, comparing its $11 FMV to its original basis.
My head is officially spinning a little. Gas fees are their own taxable disposal, and they adjust the basis or proceeds of the main transaction. Meticulous per-transaction tracking of the cost basis of the crypto used for gas is essential.
It is. Absolutely crucial. And since gas fees can fluctuate wildly, getting this right can significantly impact your overall gains and losses. This is where crypto tax software becomes almost indispensable, though even it can struggle without perfect data.
Okay, deep breath. Let's shift gears slightly to NFTs, non-fungible tokens. They exploded and bring their own tax wrinkles.
NFTs, unique digital assets on the blockchain. Like other digital assets, the IRS generally treats them as property.
But there was a big development about NFTs possibly being taxed as collectibles with a higher tax rate.
Yes, that was significant. Guidance from March 2023. The IRS signaled they might treat certain NFTs as collectibles. Why it matters. Long-term capital gains on collectibles get hit with a higher max rate, 28%.
Ouch, compared to 0, 15, or 20% for other long-term assets.
Exactly.
Big difference.
How do they decide if an NFT is a collectible? Is it about the art?
It's based on a look-through analysis. Depends on the underlying asset the NFT represents, based on the tax code's specific list of collectibles.
Okay, give me the examples.
IRS said.
Yeah.
An NFT representing ownership of a physical gem, likely a collectible because gems are on the list, but an NFT representing virtual land in a metaverse. Not a collectible because metaverse land isn't on that specific list. Art, antiques, metals, gems, stamps, coins, etc.
So it's not the NFT itself, but what it points to judged against a specific IRS list.
Precisely. Critical for figuring out that long-term gains rate.
And the tax treatment also differs if you're just investing versus creating NFTs as a business.
Yes, another key split for a hobbyist investor.
Okay.
Minting an NFT, usually not taxable itself unless you pay fees in crypto. Using crypto for minting fees or gas. Taxable disposal of that crypto, gain loss on the crypto used.
Buying an NFT with crypto.
Taxable event. You disposed of the crypto you used to buy it. Gain loss on that crypto. The NFT's cost basis is the FMV of the crypto spent, plus fees.
Selling an NFT.
Capital to gain or loss. Sale price minus cost basis. Holding period matters. Short-term, ordinary rates, or long-term, 0.1520%, or maybe 28% if it's deemed a collectible.
Trading crypto for an NFT or NFT for NFT?
Taxable exchange. Disposal of what you gave up.
Can you tax loss harvest with NFTs?
Yes. Sell to loss to offset gains, same rules apply. Up to $3K offset against ordinary income, too.
Okay, that's the hobbyist. What about NFT creators running a business?
If creating and selling NFTs is your business, they're treated like inventory. Profits from sales are ordinary self-employment income.
Meaning income tax plus self-employment tax.
Correct. Social Security and Medicare taxes on top. Reported on Schedule C.
What about royalties? Creators often get a cut of secondary sales.
Yeah, royalties. The IRS hasn't given super specific guidance just for NFT royalties yet, but generally. If you're a professional creator business, royalties are likely ordinary business income, subject to self-employment tax, on Schedule C. If it was somehow a truly passive one-off thing, maybe Schedule E, but business treatment seems more likely for active creators. Lack of explicit guidance means, again, talk to a pro.
Are there NFT things taxed the same for both hobbyists and creators?
Donating an NFT to charity is one. If you donate an appreciated NFT directly to a qualified charity, a 501c3.
We'd held it over a year.
Yes, held over a year. You generally avoid the capital gains tax on the appreciation, and you might get a deduction for its fair market value against your income.
But if you sell it first, then donate the cash.
Sale is taxable. Then you just deduct the cash. Direct donation of the appreciated asset is key for the tax break.
And play-to-earn gaming often involves NFTs and tokens.
P2E gaming.
Yeah.
That's a potential tax minefield. Most in-game actions involving crypto or NFTs likely have tax consequences. Earning rewards, usually ordinary income, trading assets NFTs in-game, usually crypto-to-crypto swaps, capital gains losses. Every little thing needs tracking.
With unique things like NFTs, valuation sounds like a massive headache. How do you even determine the FMV for reporting income or basis?
You are absolutely right. NFT valuation is incredibly tough. They're unique, markets can be thin. Unlike Bitcoin, there's no single exchange price.
So what do people do?
Practical approaches without clear rules. Some use the collection's floor price, maybe the last sale price of that specific NFT, or an average of recent sales.
Aren't those methods okay with the IRS?
That's the problem. No explicit IRS guidance on how to value them. Floor price might undervalue a rare one. Last sale might be outdated. For high-value NFTs or income reporting, maybe you need a professional appraisal. But digital asset appraisal is still a new field, can be pricey.
Wow, so valuation ambiguity is a huge compliance challenge.
It is, especially for creators or active collectors. Another reason professional advice is often needed.
Okay, summing up NFT taxes. Property, maybe 28% collectible rate depending on what it represents. Different rules for hobbyists versus businesses. Royalties are tricky. Donations need careful handling. P2E is a tax maze, and valuation is a big practical hurdle.
Yes.
Wow.
It really is. Underscores the need for meticulous records.
With all these potential taxable events, income from staking airdrops, DeFi forks, gains from sales, swaps, using crypto, liquidations, how do you actually tell the IRS about it all, the reporting part?
This is arguably the most critical piece. Starts right on page 1 of your tax return, Form 1040, 1040-SR, 1040-NR.
That digital asset question, the yes-no box.
Exactly. Prominently featured. Also on business forms. Revised for 2023, to be clear.
It seems simple, yes or no, but the implications are huge.
They are. Answering truthfully is non-negotiable. Checking no when you should have checked yes. That can expose you to big penalties, potentially even tax fraud charges. The Gordon Law Group source highlighted that risk.
Because checking no basically tells the IRS you had zero reportable digital asset activity.
Exactly. Which might be false if you did any of the things we've discussed.
So specifically, when must you check the yes box, according to the IRS?
The instructions are pretty clear. Check yes if, anytime during the year, you did any of these with digital assets, received them as payment for property services, received them as a reward or award, got new ones from mining, staking, similar activities, got new ones from a hard fork, disposed of any in exchange for property services, disposed of any in exchange for another digital asset, crypto to crypto swap, sold any digital asset, or otherwise disposed of any financial interest in one.
That covers pretty much everything we identified as potentially taxable.
It absolutely does. If you did any of those, you check yes. The bar for checking yes is very low for anyone active in crypto.
Okay, conversely, when can you safely check no?
You can check no only if your digital asset activities were limited solely to one or more of these three things. Just holding crypto in a wallet or account, transferring crypto between wallets, accounts you own or control, buying crypto using US dollars or other real currency fiat.
So if I just bought Bitcoin with dollars on Coinbase and held it, or sent ETH from my MetaMask to my ledger, check no.
Correct.
But if I sold any, swapped any, earned any staking rewards, used ETH for gas, got an airdrop, check yes.
Correct. The vast majority of people doing anything beyond buy and hold or internal transfers will need to check yes.
Okay, once you've checked yes, where does all this stuff actually go on the tax return? Income first. Staking, airdrops, DeFi rewards.
That kind of income generally goes on Schedule 1, Form 1040, for additional income. Likely on Line 8's other income. You report the fair market value at the date you receive control.
And capital gains and losses. From sales, swaps, spending crypto, liquidations.
Any disposal of digital assets. You have to report the details of each transaction on Form 8949, Sales and Dispositions of Capital Assets.
Each transaction. That could be thousands for active users, especially with gas fees.
It can be. Form 88549 is where you list date acquired, date disposed, proceeds received, cost basis. Then the totals from Form 8949 get summarized on Schedule D, Form 1040, Capital Gains and Losses.
Okay. Schedule D calculates the net short and long-term gain loss.
Yes, and that total flows to your main Form 1040.
What about business income, like
Right.
that pro NFT creator?
If it's a business selling crypto or NFTs as inventory, that income goes on Schedule C, Form 1040. Profit or loss from business. Gross receipts minus expenses. Net profit subject to income tax and self-employment tax.
Then gifting crypto, if it's a big gift.
Might need to file Form 709, the gift tax return, depending on the value compared to the annual exclusion amount.
All this reporting, it's about to get even more intense with new regulations, right? Form 1099 DA.
Absolutely. Huge change coming. New rules finalized late 2024 require crypto brokers, exchanges, maybe some wallets, other platforms to issue a new Form 1099 DA.
To users and the IRS.
Yep. Starting with the 2025 tax year, reported in early 2026. This form will detail your gross proceeds from sales and exchanges. Potentially cost basis info, too, if the platform has it.
So the IRS won't just have to figure things out from blockchain analysis. They'll get detailed reports directly from the platforms.
Exactly. The idea that crypto transactions are invisible to the IRS, that's completely over. Compliance isn't just legally required, it's becoming practically unavoidable if you use regulated platforms.
Which leads perfectly to the next point. The IRS knows. Or at least they have really good ways of finding out now.
That old myth of crypto being untraceable, it's dangerous. Yes, addresses are pseudonymous, but the ledger. Public. Permanent. Every transaction recorded forever.
But linking that pseudo address to me...
Several ways. One,
Nah.
most people touch centralized exchanges eventually. Exchanges have KYC. Know your customer rules. They collect your real ID, social security number, etc. They share data with tax authorities.
Okay, KYC on exchanges.
2, the new 1099 DA reporting we just talked about. Direct data feed to the IRS.
Right.
3, advanced blockchain analytics tools. The IRS and others use software like Chainalysis, mentioned in the sources. These tools can analyze transaction flows, link addresses, trace funds, and connect on-chain activity back to real-world identities, often through those KYC'd exchange points.
So they can follow the money, even if I move it through several wallets and eventually connect it back to my exchange account.
Precisely. They see the path. If funds leave a KYC'd account, go to DeFi, then somewhere else. Analytics can often trace that back.
What about mixers? Tools like Tornado Cash designed to break the chain?
The sources were clear. Mixers are on the IRS radar. They're not a safe way to evade taxes. Using them to hide taxable stuff is a huge red flag for tax evasion. Can lead to serious legal trouble, way beyond just tax penalties. Assume the IRS can trace transactions or find patterns that trigger audits.
Then the cost of getting it wrong, failing to report, underreporting, it's steep.
It is. Penalties can be severe. First, the accuracy-related penalty, 20% of the tax you underpaid.
20%. For what?
For negligence, carelessness, reckless or intentional disregard of the rules. Even just not keeping proper records could be seen as negligence.
And there's a specific penalty for substantial understatement.
Yes, same. 20% penalty applies if you understate your tax by more than 10% of what you owed, or $5,000, whichever is greater.
Plus interest on top of the tax and penalties.
Correct. Interest starts accruing from the original due date, usually April 15th. It adds up.
And the biggest risk, answering no to that digital asset question when you should have said yes.
As the Gordon Law Group source warned, if you should have checked yes and didn't, especially with significant unreported amounts, the IRS could see that as intentional misrepresentation. That opens the door to potential tax fraud charges.
Which means?
Much steeper financial penalties, up to 75% of the underpayment and potential criminal prosecution. Prison time isn't off the table for serious tax fraud. Compliance is the only safe route.
Okay, compliance is essential, penalties are scary, IRS is watching. But are there legal ways? white hat strategies to minimize the crypto tax bill within the rules?
Absolutely. Tax evasion is illegal, but tax planning is smart and legal. Several strategies were mentioned.
The simplest, maybe most impactful, holding for over a year.
Yes. Straightforward and effective. Hold assets more than 12 months before selling. You qualify for those lower long-term capital gains rates, 0.1520%, unless it's a collectible at 28%. Big savings compared to short-term rates.
Tax loss harvesting, selling losers to offset winners.
Powerful strategy. Sell assets that have dropped in value to realize a capital loss. Use those losses to offset capital gains. If losses exceed gains, use up to $3,000 loss against ordinary income. Carry forward the rest.
Reduces taxable income significantly. Need good records for cost basis, though.
Definitely. And while wash sale rules don't technically apply to crypto yet, many pros advise caution, maybe wait 31 days before buying back the exact same asset you sold at a loss, just in case.
Okay. Using loans instead of selling.
If you need cash.
If you need liquidity, borrowing against your crypto, fiat, or stablecoins is typically not a taxable event when you get the loan. Selling crypto to get cash is taxable immediately, so borrowing lets you access funds without realizing gains.
But carries liquidation risk if the market drops.
Huge risk. Need to manage that LTV ratio carefully. What about using liquid staking tokens, LSTs? Is that a strategy?
This is more advanced, nuanced, and relies on interpretation in a gray area. The idea, instead of getting taxable staking income periodically, you get an LST that represents your stake position plus rewards. The LST appreciates relative to the underlying asset.
So you defer tax until you sell the LST and maybe get capital gains treatment.
That's the argument. Earning through appreciation, not direct income. However, the tax treatment of LSTs is debated. The IRS could view the value accrual differently. It's complex, carries risk, definitely needs professional advice.
Simpler strategy, buying new crypto or NFTs with fiat instead of appreciated crypto.
Yes. Simple but effective. Want to buy something new? Use dollars from your bank. Don't use crypto that's gone up a lot because spending that crypto is a taxable disposal. Using fiat avoids triggering that gain.
Donating appreciated crypto or NFTs directly to charity.
Great strategy if you're charitably inclined. Have crypto NFTs held over a year that appreciated. Donate them directly to a qualified 501c3. Avoids capital gains tax on the appreciation. Potentially get a full fair market value deduction, up to limits. Selling first, then donating cash. Taxable sale. Direct donation is key.
And finally, just timing your sales wisely.
Consider selling assets with big gains in years. Your overall income is lower. You might fall into a lower capital gains bracket, maybe 0% or 15% instead of 20%, could make a difference.
These strategies sound useful, but navigating them, especially with all the ambiguity in DeFi, wrapping, bridging, NFTs, it feels like a lot.
It is. Even with guides and software, the rules are complex, evolving, lots of gray areas, specific protocol mechanics, timing of control, valuation issues. It's tough even for experienced people.
So when is it really time to stop DIYing and call a professional?
Honestly, if you've done anything beyond simple fiat buys and sells or have significant volume or value, strongly consider consulting a qualified tax pro, a tax attorney or CPA who specializes in crypto.
They need crypto expertise specifically.
Absolutely. They can help interpret rules for your situation, advise on strategies, navigate gray areas, ensure accurate reporting, and help if you get audited.
Tax software helps with the math, but doesn't replace that expert judgment.
Exactly. Software is invaluable for tracking, calculating, reporting. Automates the grunt work. But it relies on your inputs. Often defaults to conservative views in gray areas. It can't give personalized advice, assess risk tolerance, or do strategic planning like a human expert can. For anything complex, high stakes, or aggressive, pro guidance is essential.
This has been incredibly detailed, maybe a bit intimidating, honestly, given the complexity and the penalty.
It is complex, and the stakes are high.
Yeah.
But the biggest takeaway, understand the core principle. Crypto is property.
Yeah.
Know the difference between ordinary income and capital gains losses.
Yeah.
That's your starting point.
And then realize almost everything you do on-chain could have tax implications.
Yes. And the responsibility for tracking it all, calculating it, reporting it, that falls squarely on you, the taxpayer. Especially now, with the IRS getting better data.
Meticulous record-keeping is just non-negotiable.
Paramount. The crypto space innovates like crazy. Tax rules lag behind, creating complexity. But your obligation to comply, that doesn't change.
It really makes you think, what new DeFi thing or token mechanic will pop up next year, and how will you figure out how to report it? Or maybe the flip side is, Will the IRS ever give us truly simple, clear rules for all this? That's the big question, isn't it?
It really is. For now,
Yeah.
stay informed, keep diligent records, and please don't hesitate to get expert help when you're unsure. Being proactive is way better than dealing with problems later.
A huge thanks for walking us through these very tricky U.S. crypto tax situations. So much detail, but absolutely crucial information for anyone in this space.
My pleasure. It's a challenging area, but one everyone involved needs to grapple with.
Stay informed, stay proactive, and we'll see you on the next deep dive.